Liquidation is the process of winding up the affairs of a business by selling its assets, paying its liabilities, and distributing the remaining cash to the partners in return for their interest in the partnership. Unlike dissolution, liquidation actually leads to the termination of business operations. In other words, actual business activities cease in liquidation. In dissolution, the operations of the business are not necessarily affected. Liquidation may be by total or by installment. The difference is that in liquidation by total or by lump sum, the entire process is done over a short period of time. While in liquidation by installment, the process extends over a relatively long period. Needless to say, it is easier to prepare a statement of liquidation in liquidation by total than by installment. Instead of discussing all the theories first and make you feel sleepy, let's jump right on this problem. And as we go along, I'll be discussing important related terms and concepts. Megara Partnership's Statement of Financial Position as of February 29, 2020 is given below. So we have the asset, liability, and equity accounts of the business. The partners decided to liquidate the partnership. The partners' profit and loss sharing ratio is 40%, 40%, and 20% for Michael, Gabriel, and Rafael respectively. Prepare a statement of liquidation with supporting entries, assuming the following independent cases. Letter A. The non-cash assets were sold for 1,500,000 pesos. Letter B. The non-cash assets were sold for 1,125,000 pesos. Actually, the first accounting procedure in liquidation is to adjust the books of the partnership and close the nominal or temporary accounts in order to update the capital balance of each partner. But in this problem, no adjustment data is given. There is also no information as to the revenue, expense, and drawing accounts. And so, that means these accounts in the statement of financial position of Megara Partnership have already been adjusted or updated. That's the reason why the first requirement of the problem is not to make adjustments or to revise the partner's equity, but to prepare a statement of liquidation. Just like financial statements, financial transaction worksheet, and trial balance, a statement of liquidation must have a heading consisting of 3 lines: the name of the company, the name of the statement, and the date. Then, we use the given accounts in the statement of financial position of Megara Partnership as our money column headings. We start with cash. Now, since this problem concerns total or lump sum liquidation, where the selling price or cash received from the sale of all the non-cash assets is given as a single or lump sum price, in our statement of liquidation, we can just combine all these non-cash asset accounts into one and call it non-cash assets. Then, we continue on with trade and other payables. Then, we have the capital accounts. But let's include each of the partners' profit and loss sharing ratio in our money column headings for the capital. 40%, 40%, and 20% for Michael, Gabriel, and Rafael, respectively. So, for Michael, 40%, for Gabriel, 40%, and for Rafael, 20%. Then, let's write the balances before liquidation as given in the problem. 390,000 for cash. For the non-cash assets, we have to get the total of these three. 225,000 trade and other receivables plus 360,000 merchandise inventory plus 825,000 property, plant, and equipment will give us the total non-cash assets of 1,410,000. Then, trade and other payables, 900,000. Michael capital, 180,000. Gabriel capital, 330,000. And finally, Rafael capital, 390,000. Case A of the problem states, the non-cash assets were sold for 1,500,000 pesos. When the non-cash assets were sold, what happened to the non-cash assets? Decreased, naturally. How much was the decrease in the carrying value of the non-cash assets? This entire 1,410,000, because all the non-cash assets had been sold already. Well, the problem does not specifically say all of the non-cash assets were sold, but that's already understood from the phrase, the non-cash assets were sold. To emphasize decrease, open close parenthesis, 1,410,000. How much was the cash proceeds from the sale of the non-cash assets? Here, 1,500,000. The non-cash assets were sold for 1,500,000. So this 1,500,000 was the amount of cash received from the sale of the non-cash assets. So, when the cash of 1,500,000 was received, then the cash of the partnership increased by that amount, 1,500,000. By the way, the process of selling and converting non-cash assets into cash is known as realization. Please remember that for every row, the total assets must always equal the total liabilities and partners' equity, just like in financial transaction worksheet. So far, for this row, total assets amount to 90,000, right? That is 1,500,000 minus 1,410,000. But the total liabilities and equity, we have nothing yet. That means we are not done yet with this row. Notice the description here. It's not just realization or sale of assets, but realization and distribution of gain. How much is the gain? 90,000. The difference between 1,500,000 cash received and the carrying value of the non-cash assets. That gain of 90,000 must be distributed among the capital balances. of the partners using their profit and loss sharing ratio. So, 90,000 gain times 40% equals 36,000 for Michael and for Gabriel also, because both of them have the same profit and loss sharing ratio of 40%. And 90,000 times 20% equals 18,000 for Rafael. No open close parenthesis because the gain increased the capital balances of the partners. Now, get the balance of each money column. For cash, 390,000 plus 1,500,000 will give us 1,890,000. For non-cash assets, 0. Not surprising at all because all the non-cash assets have been sold already. So the balance must really be 0. Then, bring down this 900,000 for trade and other payables. Michael capital, 180,000 plus 36,000 equals 216,000. Then, 330,000 plus 36,000 for Gabriel will give us 366,000. For Rafael, 408,000. After realization or the sale of the non-cash assets, the partnership liabilities to outside creditors must be paid. Because just as personal creditors have the first right over the personal assets of the partners, the partnership creditors have priority over the assets of the partnership. When the liabilities are paid, the liabilities decrease. So, open close parenthesis, 900,000 under trade and other payables. And also, cash, of course, decrease for the same amount, 900,000. Get the balances now. Last step, the remaining cash of 990,000 is then distributed to the partners in return for their capital. So, the cash decreases by 990,000. 216,000 of the 990,000 cash would go to Michael, decreasing his capital for the same amount. Gabriel gets 366,000 in exchange for his capital balance, while Rafael receives 408,000 in settlement of his interest. After that, there is no more balance in any of the accounts of the partnership because the partnership is no more, having been already liquidated. But aside from this statement of liquidation, the problem requires us to prepare the necessary journal entries. If you already know by heart the normal balance or increased side of each account, then this must be a breeze, like a walk in the park for you. For the realization and distribution of gain, notice here, the cash increased by 1,500,000. So to increase cash, debit 1,500,000 cash. the non-cash assets decreased. To record the decrease, credit. But please, don't credit using the account title non-cash assets, but the account names given in the problem. Actually, we should debit or credit the specific individual accounts which can be found in the ledger and notes to financial statement. However, in this problem, only the line items or account classifications in the statement of financial position are given. Therefore, we have no choice but to use these account names. So, we credit trade and other receivables for 225,000. Credit also merchandise inventory for 360,000 and property, plant and equipment for 825,000. Then what? The capital balances increased. So, credit Michael capital for 36,000. Credit also Gabriel capital for 36,000. And credit Rafael capital for 18,000. That's the first entry concerning the realization and distribution of gain. Next is the payment of liabilities. Debit, trade, and other payables for 900,000. And credit, cash, also for 900,000. Lastly, the entry to record the payment to the partners. Credit, cash for 990,000. Then debit, Michael capital, Gabriel capital, and Rafael capital for 216,000, 366,000, and 408,000 respectively. Case B now. Same statement heading as in case A. Same money column headings and same balances before liquidation. The problem states here, the non-cash assets were sold for 1,125,000 pesos. Therefore, the non-cash assets decreased by the amount of its carrying value of 1,410,000 because all of the non-cash assets were sold. Cash proceeds amounted to 1,125,000. So, that increased the cash by that amount. The sale of the assets are known as what? Realization. Now, is there a gain or loss? There is a loss. How did you know? Because it's written here? Loss? Of course not. You know the sale resulted in a loss because the partnership received less than the carrying value of the assets sold. How much is the loss? 285,000. The difference between these two figures. So, 285,000 loss multiplied by 40%, the profit and loss ratio of Michael, equals 114,000. Open close parenthesis to emphasize decrease in the capital of Michael because the loss decreases the capital. For Gabriel, the same computation. For Rafael, 285,000 times 20% equals 57,000. Get the balance of each money column heading. After realization, what's the next step? Payment of outside liabilities. Upon payment, trade and other payables decrease, while cash also decreases by the same amount, 900,000. Balances again. And finally, the cash settlement for the partner's equity. The entire amount of cash is paid to the partners because there is no more outside liability. And so, the cash decreases by 615,000, while each of the partners' capital also decreases. How about the journal entries? For the realization, debit cash, 1,125,000. Debit Michael capital. Debit Gabriel capital, both for 114,000. Debit Rafael capital for 57,000. Then credit trade and other for 225,000, merchandise inventory for 360,000, and property, plant, and equipment for 825,000. For the payment of liabilities, the journal entry must be debit trade and other payables for 900,000 and credit cash for the same amount. For the payment to partners, debit the capital account of each partner. For Michael, 66,000. For Gabriel, 216,000. And for Rafael, 333,000. Then credit cash for 615,000. A very common multiple choice problem involves the requirement to compute for the cash proceeds or cash received from the sale of the non-cash assets, with one of the partner's capital balance before liquidation, his profit and loss ratio, the cash settlement to that partner, and the carrying value of the non-cash assets sold as the given figures. Let's try that in this case B. Assuming these are the given, 390,000 capital balance before liquidation of Rafael, his 20% share in profit and loss ratio, this 333,000 payment to Rafael as his final settlement, and this 1,410,000 carrying amount of the non-cash assets sold. How will you get this cash received of 1,125,000 pesos? if Rafael's interest before liquidation is 390,000 and he received a smaller amount as final settlement of 333,000, then the difference between 390,000 and 333,000 must be his share in the loss on realization, right? How much is his share in the loss? 57,000. 390,000 minus 333,000. Now, if his profit and loss share is 20%, then if we divide 57,000 by 20%, then we get the total loss on the sale of the non-cash assets. And if we subtract that total loss from the carrying value of the non-cash assets of 1,410,000, then we get these cash proceeds of 1,125,000. By the way, partner's interest means his capital balance plus loan payable to him by the partnership and minus loan receivable from him by the partnership. Although in this problem, there is no loan payable to or loan receivable from a partner. That is why the interest of Rafael here is also his capital balance before liquidation. A follow-up multiple choice question may be, if Michael's interest before liquidation was 180,000 pesos and his profit share was 40%, how much cash did he receive? Of course, we begin with his interest before liquidation of 180,000. And then what? Deduct his share in the loss on realization. How much is the loss on realization? As we have computed a while ago. Here, 285,000 total loss on realization. But we have to compute Michael's share in the 285,000 pesos loss by multiplying that amount by his profit and loss share of 40% to get 114,000. And then we subtract that amount from his interest before liquidation of 180,000 to arrive at the amount of 66,000. The cash he received as final settlement from the partnership, which is what we have here in our statement of liquidation. In part 2 of this video series on partnership liquidation, we will have another problem with different cases where you will encounter such terms as right of offset, capital deficiency, solvent partner, and insolvent partner. Have a wonderful day.